Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market just about positive by 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up. Soft jobs gains offset by strong wage growth. Amazon results deliver a beat and a raise as Apple drops on worries over a slowdown. We begin with the big issue, Jobs Day in America.
We all continue to watch both the inflation number as well as the jobs data.
The jobs report,
payrolls.
It is a huge focus.
We're very data dependent.
Watch those wage growth figures.
Wage growth really is, there's an obvious direct transmission into that price sort of spiral.
The Fed has kind of told us they'd like to see wage growth fall.
That, of course, is significant for the Fed.
We're in a period where economic data has been strengthened.
We've seen a lot of resilience in the labor market.
Resilient.
Remarkably resilient.
We've also seen a lot of air being let out.
It's difficult to say that the jobs market is anything but buoyant.
The U.S. economy continues to power through.
We do query whether the payrolls numbers are telling the real story.
There are many holes in this data.
There's still risks out there.
The Fed has to obviously consider everything in aggregate.
Let's consider that now. All-star lineup this morning, two of them with us at the moment. Mohammed Al-Aaron of Queen's College, Cambridge, alongside BlackRock's Rick Reader. Gents, wonderful as always to catch up with you on Payrolls Friday. Mohammed, you've had 30 minutes to chew over this. Your initial reaction to it?
It's the job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the lower unemployment rate. So, John, we can debate this one for a very long time. I doubt that we will get to a firm conclusion one way or the other. The marketplace favors at the margin the softer landing interpretation as of now.
Well, we have 25 minutes to debate it today. Rick Reader, what camp are you in?
So, listen, I think you've got a solid economy. You continue to have almost 200,000 jobs. And, you have a good economy, that is, but, at the margin, it's moderating. You've got an economy that's slowing somewhat. You look at this number, you look at the hours worked coming down a bit. You look at the 3-month moving average versus a 6-month versus a 12 months coming down a bit. By the way, you look at temporary hiring coming off. So, it's an economy that's in good shape, but that is moderating. And I'm in the soft landing. I'm in the no landing camp in that, I think the economy's in pretty good shape. But at the margin, this is indicative of an economy that is slowing down. Same thing you've seen in the earnings this quarter.
Well, Rick, you went there. I've got to jump in. What's the difference between a soft landing and a no landing? What's the difference between the two?
So we talked about last month. I think the economy is incredibly resilient. By the way, look at this number: 100,000 jobs, healthcare and education out of the 187. They're not cyclical. We have a service-oriented economy. That Fed raises rates 500 basis points. The unemployment rate's still sitting at 3.5. It is not the same economy we're used to seeing 20, 30 years ago. It's much more stable. It's much more service-oriented, and this number was indicative of that.
Mohammed, is this data consistent with a soft landing or no landing at all?
So it comes back to the Fed, John. Look, I would be totally in Rick's camp of the no landing. We can live with an inflation rate somewhat above 2%, an economy that continues to deliver for most American, as long as the Fed is willing to accept that the inflation rate is not going to go back to 2% anytime soon. If the Fed targets 2% and wants to get there, whatever may be, then we may not have this no landing. We may end up more in the harder landing. So ultimately, it comes back to the question that you and I have debated, and we've argued that towards the end of the year, that's the policy options that the Fed is forced to consider.
Well, Mohammed, based on recent communication from the Fed, including the recent news conference from Chairman Powell, do you get the sense they're leaning in that direction?
I don't know, John. I really don't know. The best way to lean in that direction is to keep on talking about 2%, but push it down the road. Keep on saying eventually we get to 2%. We're in no hurry. Inflation is better behaved. It's coming down. It is stable. And hope that we don't get the smile in the inflation rate, which would see headline inflation go back up towards the end of the year. But just keep on talking 2% further down the road, and then see whether this economy can absorb a 3% inflation rate, which is stable. Stable is the key word here. I believe it can, John, but I don't know whether the Fed is where I am right now.
25 minutes away from the opening bell. Equities positive here by 0.4% on the S&P 500. Mike McKee alongside us, guys, to break down this figure. Mike, what jumped out to you 35 minutes ago?
Well, I think the thing that jumped out the most is that, as Rick said, this is a labor market that is slowing gradually. And the changes that we saw in various different categories of work are, for the most part, largely fairly small, except for administration, where we lost 36,000 jobs. But most of the other gains and losses are relatively small. Headline number, as you've noted, 187,000, June revised down, and also May, a total loss of 49,000 jobs. Unemployment falls to 3.5%. The participation rate doesn't change, but average hourly earnings come in stronger than expected. So basically no change there. The Fed would like to have seen that go down along with the employment numbers. Here's the reason why we are seeing such a low unemployment rate. Household employment jumps by 268,000. Household unemployment falls by 116,000. And we also had a jump in the labor force. Manufacturing jobs down 2,000. That's what kind of everybody's expected. And leisure and hospitality, only 17,000 jobs. Remember when that was a gigantic category that was adding jobs left and right? And of course, the other number that the other part that everybody's paying attention to is these average hourly earnings. And I want to show you, if we have this, they're calling it up here. This is the issue still. The sort of blue turquoise line at the top is where we are on a year-over-year basis, 4.4%. And that green band is where the Fed wants average hourly earnings to be, between 3 and 3.5%, to keep inflation stable. And so we've still got to see that come down. When that blue line goes into the green band, the Fed can feel like maybe its work is almost done.
Mike McKee, thank you, sir. Rick, you used the word moderating. I want to build on that. Payrolls growth is moderating. Wage growth is still hot. Do you think the moderation we've seen so far on the former is sufficient enough to have confidence that the latter will follow, that wage growth, we can take some heat out of that?
So I'm going to take a slightly different take on it. The wage growth is all in the lower income jobs in this country. You're closing the income gap in the country. You may look at it when you break it down by lower income jobs, higher income jobs. Where are we losing jobs? Some tech, some finance. Where are we gaining jobs? You're talking about healthcare, education. Those are the lower wage jobs. Let's say inflation stays sticky at 3-ish, as Mohammed suggested. What if higher wages accrued to lower income, that cohort that tends to be hurt by higher shelter costs, energy costs, it's a food costs. So I think, yes, is it something, would you like to bring the wage down a little bit? Maybe, but you've raised rates a lot, you're at a restrictive rate. And quite frankly, I actually think for years we tried to close the income gap in this country. You look at some of the union labor agreements, UPS, we're going to see UAW. Gosh, I don't think it's a bad thing that we run a bit more elevated at this point.
Mohammed, is Rick describing labour market nirvana?
What Rick is saying is absolutely critical, John. We have to stop focusing on wage growth as the only driver of inflation. There are other drivers. This economy can accommodate wage growth for the lower paid employees. And let's not forget that the share of wages in GDP, the share of labor, has been coming down steadily for decades. So we can accommodate this 4% wage growth, provided productivity picks up, provided more is done on the supply side. And I think this is how we should be thinking. I really worry when the debate gets narrowed to just wage growth and inflation. It has happened in the UK as well, as you know, John. But the debate should be much wider and should bring in other elements that promote productivity, that promote economic growth, because there's been an enormous increase in inequality, as you know, and we cannot continue with high levels of inequality like this.
Mohammed, Rick, you're going to stick with us. We still need to talk about this bond market and the move we've seen so far this week. In the bond market this morning, unlike the previous 4 days, yields higher this morning. Yields lower on a 10-year by 3 basis points, 4.15 on a 10-year right now, with some movers into the open. Here's Abby.
Hey, John. Well, let's take a look at the big ones. And of course, I'm talking about Amazon and Apple. So Amazon soaring to the upside after they put up big revenue and the idea that they are also going to be reining in spending so that sales growth will be able to stand out, up 9.2%. Apple, on the other hand, a similar story to Microsoft, although probably worse. Microsoft, of course, high single-digit revenue growth, while Apple now declining, down 1.4%, the third quarter in a row. So concerns that the demand for iPhones not so strong and some of their other products, that stock now down 3%. The massive laggard on the day, though, John, Fortinet, the cybersecurity stock, plunging down 18.5%. I believe this is at least the worst day in a number of years, and they basically cut deeply their revenue and billings guidance for the year.
Abby, thank you. Coming up on this program, President Biden leaning on the labor market.
We're still seeing some lingering effects of the pandemic on the jobs market. So everything from the rate of hiring to the labor supply. There's still some industries like leisure and hospitality, like government, that have scope for catch-up. I think that's going to help bolster payroll growth still over the next few months, even as we have seen demand for workers come down.
Labour power in America, that conversation up next. And on this bond market, Rick Reeder and Mohammed Al-Arian.
What we have seen is a reflection of the still incredibly tight jobs market and all this union activity that we've seen, both in terms of some pretty heated negotiations, as well as a pickup in actual strikes and increasing number of workers actually out of work because of these work stoppages. But it's also, of course, a reflection of just the extraordinary inflation environment we've seen.
Sarah House of Wells Fargo weighing in on the U.S. labour market. Jobs in America serving as a key pillar of President Biden's 2024 election strategy. In recent weeks, the president making a series of speeches focused on job creation, manufacturing and unions. Meanwhile, today's payrolls number coming in lower than expected, with the unemployment rate falling once again. Kaylee has more. Hey, Kaylee.
Hey, John, we haven't gotten an official statement from the White House yet regarding this morning's numbers, but this is probably going to fit into President Biden's broader narrative that he's growing the economy from the middle out and the bottom up. He likely will cling to that 3.5% unemployment rate, as he's continually pointed to the fact that the unemployment rate has stayed below 4% now for 18 months in a row, the longest stretch since the 1960s. And that wage growth figure also probably something that the president is going to tout, as wage growth is outpacing inflation at the moment. But on the subject of wages, John, this really does come down to the union question, as President Biden has also tried to bill himself as a pro-labor president. And yet labor strife, as we all know, seems to have been building this summer. Of course, you have over hundreds of thousands of writers and actors in Hollywood currently on strike, a narrowly avoided strike between the Teamsters and UPS. But now the United Auto Workers potentially could be striking here in the not so distant future if a contract isn't agreed to. And we know they've asked for a 40% hike in raises. The news just in the last 24 hours. So that complicates the messaging for this pro-labor president. We also have to keep in mind that his economic messaging broadly doesn't seem to be resonating that much at this point. A CNN poll released yesterday showed he has just 37% approval on the economy, only 30% approval on his handling of inflation, and 51% of those surveyed said the economy is getting worse. John.
Katie, thanks for that. And it's coming with some extra debt as well. This headline out of the Treasury in the past week, the Treasury penciling in some $1 trillion worth of issuance in all this quarter. Mohammed Al-Arian back with us, Rick Reeder with us too. Mohammed, we've had quite a move this week in the bond market. Before today, so take out the move this morning, we had a move of more than 20 basis points on a 10-year. Was the additional Treasury supply a dominant factor in that?
It certainly was an important contributor. Look, you have 4 factors in play domestically and then an international overlay. So supply, issue number 1, and I think that is dominant, but Rick can speak with more authority on that. Second is people are starting to revisit the longer-term inflationary outlook. Third is growth that is stronger than people expected. And then finally, and I would really put it in the bottom, some people reacted to the Fitch downgrade. Then put on top of that what's happening in Japan in particular, and what is turning out to be a very muddled middle exit from yield curve control. And that explains not only the sharp move up in yields, but also what's been happening to the curve.
So, Rick, from your perspective, what was the dominant factor behind this week's move?
So, I'd say everything that Mohammed said is right. I think the other one that's in there, I think the interpretation of the economy is in decent shape, and maybe we say stickier inflation is significant. Jonathan, I think there's a really big deal. When we talk about in your show for many months now, I joke about, I like the front end of the curve, I like commercial paper. You look at this year, the ag is up 50 basis points, but the back end's down 90. And you wonder, what is the long end doing for you? You've got an inverted curve. You're in a year where you want to clip coupon. You've got bills at 5.5. You've got, clip coupon, get carry. Is the long bond a hedge? I don't know. If inflation is higher, that's going to hurt the risk markets. So I think, if there's not a pension fund life insurance bid for it, which is, generally your bid for the long end of the curve, what is the value in an inverted curve with stickier inflation? What is the value of the long end? And I think people have gotten, look at this month alone, the total return of the long end of the index is down almost 4%. If you think about what is my long duration risk that I want to take, do I want 30-year treasuries or I want equities? And I think long duration is becoming, long interest rate exposure is becoming questionable as value.
So, Rick, this begs the question, the obvious question, if 420 doesn't get it done for you, does 450? Does 5%? At what point, how far does that have to go before it is actually competitive and draws attention from people like you?
So, that's the first thing I would say is, credit. If you buy some long dated credit where you're getting some spread, that gets you to yield levels that are reasonable. That being said, I still rather hold the front to the belly where you're getting, the curve is going to steepen. When the economy slows or as it is moderating, the curve's going to steepen. So, a bit of credit in the back end makes sense. But listen, I think there's going to be a point in time where the economy starts to moderate and the Fed, you start to interpret that the Fed can start to cut rates, and there'll be a grab for interest rate exposure. So, gosh, is it around these levels? It really is what the forward trajectory of rate is going to be from here. And once you get the sense that the Fed will start moving rates lower, and we're not there yet, then you want to grab some long interest rate exposure. But I just don't think we're at that point yet.
With that in mind then, Mohammed, how much higher can these yields go at the longer end of the curve?
They can go higher. I suspect that we may well see 425 to 430 on the 10-year. Beyond that, it's going to get a lot harder. But they can go higher. John, the short end, as Rick said, is attractive. People are noticing bank CDs at 5% for a 2-year maturity. People are thinking, you know what, that's not bad. And they're not looking well beyond that. So I completely agree with what Rick said. It's hard to convince people to go towards the long end if you don't believe there's a hard landing coming, and the narrative has moved firmly away from that. And also, in addition to that, if you can get something attractive that just pays you to wait. And this notion of paying you to wait is a completely different paradigm than what we had during the era of QE and floored interest rates.
Well, let's think through the dynamics that you guys are describing. We've got central banks backing away, the BOJ tweaking yield curve control. I'm still confused as to what the goal actually is over at the Bank of Japan out of Tokyo. And Rick, the anchors that we've had around the neck of the global bond market for the last 10 years, up and away, Germany, gone, done. They're talking about QT in Europe, never mind QE. Over in Japan, yield curve control, those tweaks starting to come through. Rick, we haven't had accidents really in a material way post-pandemic in this bond market at the long end in the way that some people might thought maybe we would based on these central banks pulling away. The cycle high, the post-pandemic cycle high on a 10-year, I believe was October, Rick, it was 430. Do you think we can actually get through those kind of levels again later this year based on what you're expecting?
So, the one governor on rates moving significantly higher is if you believe, which I do, that inflation is moderating, that the real rates are starting to expand. And then, people look at that, as you get to, a couple of % of real rate, gosh, then, you start to get appealing. So, but do I think you can push back a bit more in the long end of the curve? Yeah, I think so. Listen, we think the next, we're going to get a CPI report. We think that's going to be a soft report again. probably buoyed by the same thing as last month, lower used car prices. So, listen, I think rates can move a bit higher in the back end, but I don't think they're going that much higher. And I think Mohammed said it earlier. I think the equity market has gotten to a place where you can absorb this sort of these sort of higher rates, and they'll probably be with us for a period of time. So I don't really see an accident. I do think we still have a challenge around commercial real estate. I do think we have a challenge around small banks in the country, but I don't think there's a big structural problem as long as the housing market, which is in pretty good shape, stays firm.
But Rick, to be clear, you still like stocks here?
I do. I mean, if you said, again, it goes to the point of I've got long durated risks that I can take. I don't want to take it in the back end of the Treasury curve. I think equities, and are we shifting our equity exposure a bit? There are a lot of businesses that actually trade at low multiples. We talk about autos, talk about airlines, home builders, parts of the energy sector that trade at pretty low multiples. European banks trade the low price to book. There are enough stocks that have, we can debate, semis. But there's enough equities that get you low multiples that as long as you believe the economy is moderating but in decent shape and the central banks are off the tightening boil, they're okay, to hold here. Particularly alongside, I've got carry in the portfolio that gives you a lot of ballast for what is a pretty stable portfolio today.
Gents, let's keep doing this. I love this. My favorite day of the month. Rick Reader, Mohammed Al-Erin, post payrolls. Enjoy it. Have a great weekend, guys. Appreciate it. Post payrolls, Mohammed Al-Erin there and Rick Reader responding to that jobs number. Just a slight downside surprise on the headline number. Equities right now positive by 0.4% on the S&P. Coming up, the morning calls in later. Michael Collins of PGIM, Anastasia Amoroso of iCapital, joining us around the opening bell on what's happened in this labour market. And joining us on tech and Apple specifically, Angelo Zeno of CFRA. All of that still to come. Your opening bell, 7 minutes away. 5 minutes away from the opening bell. Equities just a little bit firmer by 1/3 on the S&P 500. That's the price action. Let's get to some morning calls. Rosenblatt downgrading Apple to neutral. The analyst seeing third quarter results highlighting a slowdown phase. Morgan Stanley raising its Amazon price target 175 from 150. The analyst citing strong results and guidance across the company's retail and AWS units. And finally, TD Cowen downgrading Moderna to market perform. The analyst saying near-term catalysts remain tight. Coming up, more on the latest payrolls report with PGIM's Mike Collins and Anastasia Amoroso of iCapital, plus Apple earnings with Angelo Zeno of CFRA. Your opening bell just around the corner. 25 seconds away from the opening bell this morning. Good morning. Final trading day of the week, getting you towards the weekend. Equity futures positive here by 0.4%. This is how the stage is set going into the weekend before Friday's session. 3-day losing streak on the S&P. And so far, before this, on course for the biggest weekly drop going back to March. There's your opening bell. Switch on the board. The pain, the catalyst for it. In the bond market through much of the week, yields higher every single day through Thursday, and then we pull back this morning by 4 basis points. 413.70 on a 10-year, pulling back from new highs for 2023 on a 10-year yield. This morning, yields lower off the back of that job market report. The labour market report, really a tug of war between a downside surprise on payrolls and then hotter wage growth than expected on the other side of things as well. We'll debate that in just a moment. Off the back of it, the euro showing some strength, or I should say the dollar showing some weakness. 110.22. Euro dollar positive by 0.7%, and we had a bit more weight to that crude rally more recently. $81 and about 80 cents on WTI, higher here by 0.4%. About 40 seconds into the session, positive by 1/3% on the S&P. On the Nasdaq, up by a touch more. One stock to watch at the open, DraftKings. Second quarter sales beating expectations as the company raises its full-year guidance. The CEO saying this: DraftKings produced outstanding results. We grew revenue at an impressive year-over-year rate and maintained our focus on operational efficiency. Abby has more. Hey, Abby.
Hey, John. And the stock is reflecting those results. It is surging up at this point 14.5%, the best day since early May, the highest level since November of 2021. So specifically, they actually put up a surprise profit. They also beat revenue by about 15%. Analysts on the street very positive, thinking that this is going to be a bit of a turnaround for the company, that this online betting and fantasy sports betting company, that they have moved in the positive direction, positive EBITDA for the first time, and that the gambling, the momentum should continue, and especially ahead of the key NFL season. This stock, John, on the year into today, up 163%, sort of one of these stealth rallies in a name that had been beaten down last year, but right now, again, absolutely surging, up 15% on these strong results.
Hardly talked about it. What a move on the year and on the session, so far at least. Abby, thank you. Different story for Block, very different story. The company's gross profit growth forecast falling short for investors. The co-founder, Jack Dorsey, saying this: leaders across our company are now looking at the true full cost of their businesses, leading us to pull back on our pace of hiring and to focus more on performance management. Katie has more. Hey, Katie.
Hey, John. Well, it's rough out there. Block shares currently down over 9%, even though on several measures, this was a beat and a raise quarter. If you go into the numbers, gross profit soared 27% to $1.87 billion. That's above the average estimate of about $1.8 billion as both the Cash App and the Square businesses delivered. Block also boosted its full-year adjusted profit to $1.5 billion. That projection is up from $1.36 billion. And that's all good news, but it's that guide that you mentioned that's showing up in the shares today. The guide for July's gross profit growth came in at 21% year over year. That's actually slightly above Wall Street's consensus. But as Jefferies analyst Trevor Williams phrased it, that figure likely below buy-side expectations. And you can see that in the stock this morning, now down 10% as trading gets underway, higher by just 6 or 7% on the year, John.
Brutal stuff. Thanks for that, Katie. That stock getting hit hard around the opening bell about 3 minutes into the session. Want to turn to tech, the two big names. Amazon giving a positive sales outlook while Apple faces a big sales slowdown. The CEO, Tim Cook, saying, quote, "We continue to manage deliberately and innovate relentlessly, and we're driven by the sense of possibility those efforts inspire." Ed Ludlow, almost poetic from Tim Cook there.
Yeah, almost poetic, but it doesn't hide the fact that Apple is not immune to the macro environment, John. What we got was a story where the smartphone market in the US is not strong. There were bright spots, and the numbers are mixed going into the rest of the year. So ultimately, Apple beat on fiscal third quarter revenue, the quarter ending in June, coming in overall at $81.8 billion, slightly ahead of expectations. But in the fiscal third quarter just gone, iPhone revenue was softer than expected. What it means, all told, is that this is the third consecutive quarter where Apple has experienced year-on-year declines, going back to 2016 for 3 consecutive quarters. The commentary from Luca Maestri, the CFO, is that going into the fiscal fourth quarter, ending in September, they expect iPhone and services to accelerate, but other business lines like iPad and Mac to decline double digits going into that fiscal fourth quarter. The question is if Apple sees an overall sales decline year on year in the next quarter or the current period, 4 consecutive quarters of year-on-year declines, you have to go back 20 years for that level of sales decline in this company. So there's a lot happening here. Bright spots included Greater China, which overall has returned to growth. India had a record month in the month of June, and the opening of retail stores there has had a quicker than expected impact. Services revenue overall passing $21 billion for the first time. But the narrative from the street is that services has had momentum anyway. Complete contradiction with Amazon, up 9%, going towards 10%. That puts it on an intraday basis for its biggest jump since November. Amazon, the story, a beat across the park. Overall top-line growth 12%, 4% on the .com business. But they're getting better at making money on the more profitable elements of Amazon.com, namely advertising and selling services to independent merchants. Then you look at AWS, the cash cow, the bright spot. It continued to grow. And even though we'd had that guidance from the prior quarter that going into April, AWS growth had decelerated 500 basis points, what ended up happening in the quarter was it stabilized. And they stopped short of saying there's a rebound in cloud, but they talked about customers putting an end to their cost optimization. In other words, customers stopped playing it so safe. So a really strong beat, but the story is Andy Jassy having real cost discipline, and that's showing up now on the bottom line as well.
Two different stories, two very different stories. Amazon up by 9% right now, Apple down by 2.7%. Ed, we'll talk more about this, but the South Side captured this almost perfectly. You just go through some of the revised calls this morning, looking at, say, Amazon, price targets hiked, Morgan Stanley, Piper Sandler, Citi, Evercore, taking their price target from 150 to 190. We're only at 140 right now. Apple, can I just lean on this one, this quote that came from KeyBank, Ed, and get your thoughts on this? Analyst worries that the US upgrade cycle is coming to a halt. The upgrade rates are at all-time lows and likely to result in weak revenue in the United States. Now, Ed, what do you think that means going into a new product launch in the next month for this quarter?
Well, those are exactly the two factors that were addressed. In the quarter just gone, there was no substantive product launch, which didn't drive an upgrade cycle in any of the product categories. What we're waiting on is the iPhone 15. The expectation, according to Mark Gurman's reporting, is it comes in this quarter. The bigger picture commentary when asked about the macro environment is Tim Cook said we have an uneven macro situation, but the smartphone market in particular is weak in the United States. That is partly an inflation and consumer issue, and it is partly an upgrade cycle issue. And as you know, during earnings, Apple does not talk about products that are not yet released. But that is what the expectation is. And again, I go back to it, John, but for me, you always get the key detail, not necessarily from Tim Cook, but Luca Maestri, the CFO. And he gives very small but specific guidance that going into the fiscal fourth, iPhone accelerates again. And a big part of that, we think, is going to be the release of the iPhone 15.
Interesting. Ed, stay close. We'll come back to you on that. The broader market right now, a lift here, a pickup, about 7 or 8 minutes into the session, up by 0.6% on the S&P, on the Nasdaq up by 1 full percentage point. Turning back to today's jobs report, Mohammed Al-Aaron on this program a little bit earlier. Take a listen.
It's the job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the lower unemployment rate.
Joining us now to discuss two of the very best, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, you've said it before, this Fed might be on hold, it might be almost done. Do you think this data this morning backs that up?
I think it does. I think this is an in-line payrolls report, in line with market consensus, but also in line with Fed wishes. I mean, if you zoom out, if you look at the labor market data, we continue to trend down in terms of job creation, and yet we continue to see the unemployment rate that is still holding on around 3.5%. So that's really the best case scenario for the Fed, is gradual rebalancing of the labor market. By the way, job openings continue to come down as well. Labor participation rate continues to go up and is above pre-pandemic levels for prime age workers. So I think that's all that the Fed really wants to see. And of course, yes, there's a 4.4% wage growth number, but look, 4.2, 4.4, I think they're close enough. So I think the Fed is going to take that in addition to the inflation data that is showing a disinflationary trend, and will say this is in line with what we want to see, and therefore we may have to pause here.
Mike Collins, would you agree with that assessment?
Yeah, it feels like the soft landing camp is definitely winning out here, Jonathan. In fact, after today's move lower in rates across the intermediate part of the curve, the markets have effectively taken out the probability of any more Fed rate hikes. So our view is the Fed is done. The funds rate is restrictive enough. It's going to continue to get more restrictive as inflation falls, that passive tightening everybody's talking about as the real rate continues to go higher. But what's priced in for next year is still 100 basis points of rate cuts. So that's really the big question.
So, Mike, with that in mind, and I know you and the team have been thinking about this, within fixed income, am I playing for income, capital returns, total returns? What am I doing?
Yeah, as you know, we've really been short duration, Jonathan, in our strategy. That is kind of betting that the 5- and 10-year yields were too low relative to the funds rate, right? When the 10-year was at 3.5 a couple of months ago, and the funds rate is pushing against 5.5, that's too big of a gap. And as that rolls up the curve, you actually get paid to be short. But now we've had a huge move. The markets feel like they're more fairly priced, with the 10-year, at 4 1/8 today, the 20-year pushing against 4.5 the other day. That feels fair value to cheap to us. So we're covering that in and certainly advising our clients to add duration here. You are clipping a coupon. You're clipping a bigger coupon every day. It's a great yield the bond market is offering you. And you do now finally have the potential for some upside in price if you kind of continue to get a moderation in growth.
Anastasia, that's the fixed income side of things. On the equity side, I've said it a few times already this year. It's worth saying again, you've had a great year on the equity market, much more constructive than most coming into the year, and you remained constructive. Now you're looking for that broadening out. Are there reasons to believe that can continue after it started around June this year?
Yes, for sure. I think the biggest reason is economic growth. I mean, if you look at, for example, the Atlanta Fed GDP now number they came out, the nowcast for the third quarter is running at 3.9% GDP growth. I mean, that is better than the first 2 quarters. That is an acceleration versus the deceleration that the consensus was expecting. So, you know, to the extent that that holds, that certainly bodes well for companies. It bodes well for the earnings upgrade cycle, and it should bode well for the stocks. So, you know, we've obviously seen, and speaking of, you know, what kind of stocks benefit the most, I mean, if you look at the performance this week, financials, for example, didn't sell off nearly as much as technology and some of the other sectors. And part of that reason is we've seen this, you know, re-steepening of the yield curve, which of course is positive for financials, but so is a soft landing. And so is, you know, the lack of major defaults. And so is, you know, the potential for yields to maybe go down from these levels. So I would say, Jonathan, for sure, there's a broadening out that is justified. And I like that it's actually being led partially by financials.
Mike, Anastasia mentioned the move in the bond market. I want to finish there with you, Mike. That lift in yields, that steepening in the curve, gone back and forth with a range of guests on this through the week. Just what was the dominant factor behind that move, Mike? And the reason I think we've got to diagnose it is you've got to work out whether it is sustainable, it continues, and whether the factor behind it this week is something we have to live with through the rest of this year. Was it the data, Mike? Was it the supply? Was it the downgrade? A lot of people say it wasn't the downgrade. Is it the BOJ? What is it, Mike?
Yeah, I don't believe it's the credit downgrade of the U.S. Treasuries and agency mortgage-backed securities. I think it's a lot of things. The data continues to be resilient, but the positioning was offsides, right? I think the market, investors generally had gotten really long duration. I mean, it seems like the consensus had shifted to really long. We were taking the other side of that. So I think that positioning alongside pretty resilient data and a Fed that really seems like they are going to be stalwart, that they're going to hold that funds rate at a higher level for longer. That's what happened in the curve this week.
The yields this morning speak to that too at the front end. In fact, through most of this week, the front end's not done much at all. We're down by 7 basis points this morning on a 2-year at about 481. Anastasia, Mike, love doing this with you as well. Post payrolls to get an update from you both on fixed income and equity alike. About 14 minutes into the session, your equity market on the S&P 500 just about positive here by 0.5%. Coming up, Amazon impresses, Apple disappoints.
The results reflect the fact that the environment is challenging. Consumers face pressure from general interest rates, higher inflation, and so there are a lot of cross currents that Apple, like all other companies, cannot outrun.
We'll head back to the West Coast and catch up with Ed Ludlow. Plus, up next, CFRA's Angelo Zeno.
Amazon collectively needs something like $3.4 billion for an incremental basis point or a percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
Tom Forte, D.A. Davidson weighing in on Amazon, the company delivering better than expected results, reporting a spike in sales for its cloud computing arm, AWS. Different story for Apple, AWS rather. Different story for Apple, of course, dropping below its historic $3 trillion market valuation as it faces its longest sales slump in decades. Ed, back with us for a little bit more. Hey, Ed.
Yeah, so the guide from Apple is that going into the fiscal fourth quarter, it will be much of the same. If they maintain that growth rate and we do get a fourth consecutive quarter of year-on-year declines, it's the longest streak of sales declines for Apple going back 20 years or more. The big point is there is an admission from executives that there is a slowdown in the smartphone market here in the US. Bright spots in India and China were interesting. Also, we haven't talked about the impact of foreign currency. And there was a real emphasis from both Cook and Luca Maestri, the CFO, that on a constant currency basis, sales would have grown. But it just reminds us, John, Apple is a truly global business. And if you have the bright spots in markets like India and China and elsewhere, then you have to factor in the FX headwinds. And actually, sequentially going into the fiscal fourth, they did guide that that would be on an ongoing basis a headwind.
Ed, thank you, mate, for the update. CFRA's Angelo Zeno maintains a buy rating on this stock, 220 price target. I'm pleased to say that Angelo joins us right now. Angelo, let's go through this together, and thanks for being with us, by the way. Reasons to be constructive. Can you go through them for us this morning?
Yeah, listen, I think the biggest reason to be constructive, or kind of the biggest positive takeaway from this earnings call, was the services side of things. And I think most bulls would point to that. You saw 8% growth on the services side. The expectation, at least on our end, was for about 6% growth. And, it's actually finally an acceleration from what you've seen the last 3 quarters where services growth has decelerated. And actually, Apple actually indicated that you're going to see further acceleration as you go into that September quarter. So that's a change of pace to what you're seeing on the hardware side of things, and essentially all across the hardware side, specifically on the iPhones, where we saw a 2% decline on a year-over-year basis. And, I do think that really indicates the health of Apple in some respects, where you're seeing positive and accelerating services growth amid a decline on the iPhone side of things. Almost kind of tells you that they continue to do see switcher rates continue to improve and that installed base continue to grow, and that's really helping the services side of things. So I think longer term, the health of Apple remains very good. But as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
Can we build on that just in the near term, Angelo? Upgrade rates. This has been the bullish thesis for a while. You've got this big base that need to upgrade. They're going to come and buy a new phone. What's happening with upgrade rates, and how do you think that's going to change in this quarter when we get a new product launch?
Yeah, I mean, listen, I think you did have a slight acceleration in terms of the upgrade rates when you had the 5G launch. Actually, what you're looking at here in terms of the iPhone 14 cycle is replacement cycles have extended after kind of 2 very good years in terms of the 12 and the 13. But the 14 has actually held up very well because average selling prices have actually largely offset a lot of the unit declines. And that's largely due to the fact that consumers are willing to pay more for those higher priced devices, given the change in strategy Apple has made with this cycle in terms of essentially putting all the key upgrades on kind of the pro devices. Now, as we kind of look forward in terms of the 15, we're not looking for much in terms of an acceleration in terms of those replacement cycles. But that said, the comparisons get super easy as you kind of start going into the December quarter. Most people will recall some of the COVID-related headwinds a year ago, so they start lapping that. There's actually been some challenges in the U.S. market in terms of iPhones in the last 2 to 3 quarters. They'll start lapping that as well. So I think you start seeing some easier comparisons where they should be able to see a return to growth in the iPhone 15 cycle, but nothing kind of major that we anticipate until a foldable launch finally comes to fruition.
Can we just drill down on ASP just quickly? The average selling price of a phone. Angelo, there was a hope this year that if unit sales growth was stable, that they'd be able to do something with the average selling price of the phones they sell. Based on what we've learned in this quarter, do you think they can?
In terms of what? Increasing selling prices?
Putting prices up, yeah.
Yeah, I mean, listen, I think there's the potential that they can do that on the pro side of things, and it might be something that they look to do on the next cycle. But to be honest with you, given some of the challenges that we're seeing kind of specifically in the U.S. market, I'd kind of be hard-pressed to really see them really increase prices on my end of things. I mean, we'll kind of see what happens here, with the iPhone 15 cycle, but I'm not necessarily kind of embedding that within our forecast.
Angelo, thank you, sir, for the update. Angelo Zeno there, constructive on the longer-term opportunities, near-term challenges could linger. For the stock, we're down by close to 3% at the moment. About 23 minutes into the session, positive here by 0.4% on the S&P. Up next, your trading diary. Trying to snap back from a 3-day losing streak on the S&P, up by a third of 1% here. That's the price action. Let's get to the trading diary. Fed speak picking up Monday, Bostic and Bowman. Earnings picking up Tuesday with UPS Rivian and more, then Disney reports on Wednesday. Thursday, we'll get US CPI, plus another round of jobless claims. We'll round out the week on Friday with PPI and UMich consumer sentiment, and certainly hoping for a quieter week in the bond market than the week we got this week. Looking ahead to CPI, that's your big print next week. From me, that does it for me, and thank you for choosing Bloomberg TV. Have a wonderful weekend if you can. This was the countdown to the open. This is Bloomberg.